11 interest rate hikes between March 2022 and May 2023 helped pull U.S. inflation under control. Now, after nearly 2 years and 2 rate cuts, it's becoming clear that the path down the interest rate ladder won't be quite as steep as the ramp up. The Federal Reserve projected just 2 more rate cuts in 2025, potentially signaling the start of another higher for longer interest rate regime. Here are 3 highly rated ETFs that should hold their own in that kind of environment. Let's start with TCW Flexible Income ETF, ticker FLXR, an actively managed bond ETF that sits in the multisector bond category. It carries a Bronze Morningstar Medalist rating and charges a competitive 0.40% fee. This mutual fund turned ETF has a wide mandate. The experienced group that runs it gravitates towards the strengths of TCW as a whole, allocating along and within securitized debt and corporate credit. Securitized debt represented more than 60% of the portfolio entering 2025, and corporate bonds, many of which ranked as non-investment grade, shaped about 1/5 of the portfolio. That profile historically brought more credit risk than traditional core or core plus bond funds. However, FLXR's heavier dose of short-term bonds means it's less sensitive to interest rate changes than most peers. When climbing interest rates roiled bonds in 2022, this ETF shed 8.7%. That beat the Morningstar US Core Bond Index by about 4.4 percentage points and ranked among the top third of the multi-sector peer group. Moving into equities, how about WisdomTree US LargeCap Dividend ETF? It trades under the ticker DLN, earns a silver medalist rating, and charges just 0.28% per year. This index tracker puts a clever spin on a proven strategy. It weights 300 of the market's largest dividend payers by their cash dividends and gives the highest quality, highest momentum stocks an extra 50% bump. Dividend weighting protects the fund from overpriced stocks and pushes the fund into the large value category. Meanwhile, the quality and momentum considerations dial back exposure to companies that may be cheap for good reasons. Balance is everything in this broad portfolio. The high-quality dividend stocks that make up this portfolio generally navigate high interest rates well. Familiar Magnificent 7 companies headline the portfolio, but reliable franchises like Johnson & Johnson, Pepsi, and Walmart crack the top 10. That helped the fund rank among the top 20% of large value funds from 2022 through 2024, a period that featured a little bit of everything, including high rates. Let's close out today with the bronze-rated iShares MSCI USA Momentum ETF, MTUM. This fund aims to maximize its exposure to the momentum effects, a proven risk factor with a long track record of market-beating returns. Capturing momentum requires constantly changing. As the market's leading stocks evolve, this portfolio must too. So, although MTUM sat in the large blend category entering 2025, its short look-back period can pull it all over the Morningstar style box. So, why can this fund work in a higher for longer rate environment? The key is not higher, but longer. This fund thrives in consistent market regimes where the recent winners keep winning and the losers keep losing. That explains how the fund held up better than the Morningstar US Large Mid Index in 2022, when the bright spots were rare but steady throughout. Plus, this fund charges just a 0.15% fee, an edge no matter the environment.